This year, government bond yields have increased sharply across the major economies. In the US, 10-year Treasury yields have surged from 0.9% at the start of 2021 to over 1.5% now. In the Eurozone, 10-year German bond yields have reached their highest level since last summer, and in Japan, government bond yields are close to 5-year highs, over 0.15%. The significant rise in government bond yields is being driven by increasing inflation expectations and stronger economic prospects. First, vaccines are enabling activity around the world to start rebounding from the pandemic. Second, commodity prices are also rising as global activity recovers. Copper is at 10-year highs over $9,000 and Brent oil is at 1-year highs near $70. Third, inflationary fears are increasing because of the massive liquidity provided by central banks through quantitative easing during the pandemic. Fourth, the huge fiscal deficits governments have been running are also fueling fears of inflation. For example, if the Biden administration's $1.9 trillion stimulus plan is passed in full by Congress, then the US government budget deficit could again be over 17% of GDP in 2021 for the second year in a row. Last, the Fed's recent shift to a strategy of average inflation targeting is also making investors nervous about inflation risks. Thus, government bond yields are increasing sharply because of higher inflation expectations and stronger economic prospects. We expect government bond yields will rise further during 2021. This increases the risk of volatility in financial markets, but the broad rally seen in risk assets over the past year should continue in 2021, as the Fed is unlikely to taper its quantitative easing this year, nor begin raising interest rates until 2024. The Fed's dovishness matters, as major bond market sell-offs in the last few decades were all caused by central banks turning hawkish. In contrast, in 2021, we expect the Fed's dovish outlook to keep 10-year Treasury yields at low historic levels below 2% this year. This will allow the broad rally in risk assets to continue despite near-term bouts of volatility. For more information, please read the latest edition of our monthly investment guide titled Reflating Expectations.